On this bonus episode of the AI Investor Podcast from 24/7 Wall Street, we're sitting down with a special guest to bring a new voice to the AI conversation, and we answer the question, could Tesla really go to $700 per share? All of that is next. Welcome to the show, everyone. My name is David Hanson, and this is not our regularly scheduled show. That will be coming later this week. This is a bonus episode that we're very excited to bring our audience. Eric recently had the opportunity to sit down with Simon Erickson, the founder of 7investing, a market-leading research firm for individual investors. So with that, please enjoy this episode and their conversation.
Hello, everyone. I am joined by Simon Erickson, a former coworker, a good friend, but most importantly, one of the best growth analysts I know. Simon is the head of 7investing. And what we want to do today is we're building that $500,000 AI portfolio. We want to bring experts in. We want to get as many opinions across the space as possible. And Simon has been generous enough to join us today, specifically to talk about matters like Tesla, an upcoming IPO, and one stock that he's very interested in after a recent sell-off. So, Simon, glad to have you on today.
Eric, it's really a pleasure to be here. Nice to see you again. I'm glad to join your program here this morning.
Yeah, it's always nice to get some time with Simon. So let's just get right into it. You published a model on Tesla. Its shares have been absolutely skyrocketing post-election. Everybody wants to get in Tesla, believing that there's going to be favorable regulations to the company and Elon Musk in kind of Trump's cabinet. But you actually kind of have some numbers behind where you believe Tesla could be headed in the coming years. So could you kind of walk through kind of the reason that you built this model, first of all, and then also kind of the inputs that went into it and where you think Tesla shares could be if they kind of deliver on some of the robo-taxi programs they have?
Sure thing. Yeah. So first of all, Eric, everybody has an opinion about Tesla. The model was built because everybody has an opinion on this company and the stock, right? Your grandmother has an opinion on Tesla. My dog has an opinion on Tesla. Everybody says it's either the greatest thing in the world or they hate Elon and they think he's becoming too political or whatever else it might be. And so the reason for the model in the first place was to say, okay, as investors, somebody's got to do this. Somebody's got to put the numbers, onto the page and say, this is what the company can really be worth. And of course, it's impossible to know for sure how things are going to shake out for Tesla to 2 decimal points. But I think that using reasonable inputs, based on the company's historical manufacturing capacity for the cars, the expectations of the future revenues and the cash flows that are associated to those, and then also, of course, some of the other projects that Elon has committed to, we can get a pretty good feel for what the shares are or could be worth versus what they're selling it today. So that was the reason for the model. To answer the second part of your question, Tesla is a complex company. There's a lot of wheels turning, pun intended, of course, on that one. And first of all, it's a car company. You can kind of model out how many vehicles it's going to sell of each type. What's the average selling price of those? You can kind of roll up revenues and cash flows from those, especially as it's becoming more and more automated. But it's not just a car company, right? It's actually finding ways for these vehicles to incorporate recurring revenue that falls very quickly to the bottom line. If you've got a Tesla vehicle that has full self-driving software, they're charging $99 on a standalone basis for that now. You used to be able to buy it up front. Now it's kind of a recurring revenue piece of the business. And then we'll talk a little bit about the robo-taxi network and how that could be even bigger than anything that Tesla has today, even as a car company. So kind of put all those together. It took me a solid month to build the DCF model, the discounted cash flow model. But somebody had to do it, Eric. And so I was glad to do it and put it out there for 7investing.
Okay, so let's maybe break this down a little bit more. I had talked about Tesla in one of our earlier podcasts. I had said I was just a little afraid of some of the uncertainty. I passed on adding that to the portfolio. I wish I had, because it's up 70% since then. But let's talk about the input. So what do you value Tesla on just as a standalone car company? And then we'll build in the other factors.
Sure. And so again, the inputs for these, what we're trying to do is we're trying to forecast out all of Tesla's revenue. The most important piece is how many cars is it going to sell? What's the selling price of those? And then how long is that going to continue? Right. And we've seen, that's incredibly complex to even figure that out. Right. There's a lot of competition going on in China. Now they're introducing the Cybertruck. How well is that going to sell? We're talking about the Model 2, Cybercab, Project Redwood, whatever you want to call kind of the mass market vehicle. But I think we put some pretty good inputs together on just saying, as a car company, here's how many Tesla's going to do. Here's the capacity of its manufacturing that it has right now. Here's the CapEx I think it's going to expand the manufacturing that it has available. And then here's the new models it's going to introduce. How into the weeds would we like to get into that, Bleeker? I can give you kind of the higher level if you'd like, or we can kind of get into the nitty gritty if you want.
But I believe you have a specific number, and it's maybe changed. But when I had last looked at your model, it was a little over $100 just for the car company. So is that where you're at today? And what kind of inputs did you get there in terms of number of cars sold or other important factors?
Yeah, that's right. So the previous we're in the third quarter now. We just got third quarter reports from Tesla. Before this quarter, so one quarter again, Q2, they were having some problems with stockpiling inventory, specifically in China. They just weren't selling as well as they were expecting to. There was kind of, it was a little bit more pessimistic than we've gotten used to in Tesla's quarterly reports. And earlier this year, I said, as you just alluded to, that Tesla as a car company was worth about $105 a share, which was quite a haircut from where the shares were trading. I think it was around $200, $250 at the time. Basically saying that if it's just a car company, it's worth half of that. They increased that number. We got much more optimistic news here in the third quarter. They sold pretty well. They exceeded the guidance that they had for the Model 3. Cybertruck is selling better than expected. I think as a car company, Tesla's worth $141 a share. Okay, Eric, that's still a lot less. That's about half of what the shares are selling at now. But you can kind of see this is still a very difficult business when you're clawing it out with your competitors and just trying to sell cars and do a lot of the marketing and the expenses that are required to get them out there. Low margin business, the auto.
Yeah, business. And I'm thinking about this offhand. So these aren't exact numbers, but if you're at 141 per share, that's probably what, 350 to 400 billion in that range valuation. So that in your base case with automotive, without the factors of self-driving kind of flowing through, I believe that still makes them the most valuable car company in the world, correct? Toyota is somewhere 250 billion to 300 billion. I'm not sure at this moment. So that would still make them the most valuable car company, right?
Yeah, absolutely. And, this is kind of with some assumptions on top of how well they're selling right now, right? We've already seen the Model S and the Model X and the 3 and the Y, and even now the Cybertruck selling well. I expect in my model, I think by 2026, so about a year and a half out from where we're at today, we're going to start seeing 25,000 Tesla semis hitting the roads. Okay, that will be included in the car business. This is commercial freight. This is like Pepsi. They've got kind of a beta partnership. It seems like those are going well. I think that's going to scale up to 50,000 units by fiscal 2027. And then the big question, Eric, is really how well is the Model 2 going to sell? Right? Can Tesla really get a car out there that's going to sell for $25,000? I think that Elon's going to have to make a decision on whether he wants to hit that price point or if he wants to get production earlier at a higher price point. I think it's very, very difficult to get a mass market car with the way he wants to do it, with the battery range and all the other components he wants to put into these vehicles. I think that he's going to sell it at a higher price point, just like we saw with the X and with the 3 and also with the Cybertruck. I think the same thing's going to happen with the Model 2. But I expect, 500,000 units by fiscal 2026 end of year, 1 million units by fiscal 2027, and then scaling all the way up to 3 million units by fiscal 2030. Elon tends to hit inflection points pretty well. Don't hold him ever to exactly the date he's first going to say of when stuff's going to be available, but the dude is a genius operationally, and he is going to push up the scale for this quite significantly.
And can I just, one point of clarification, when you're saying 3 million units, is that across the entire business for Tesla? Is that the business-wide number? Or are you talking the Model 2?
Model 2, 3 million units alone by fiscal 2030. I think 6.3 total units, 6.3 million total units in that same year. And I've forecast all the way out to 2040. This is a company that I think is going to get to 9.5 million vehicles per year by 2040. That sounds crazy right now. We're at a little less than 3 million per year today for Tesla. But I think that they're going to continue to build more gigafactories, continue to incorporate the technologies, and I think that they're catching on quite well internationally as well.
So if you have the model in front of you, so what's your kind of year by year, 2024, 2025, let's just walk through where you see them going on a car business.
Yep, sure. Total output, total deliveries for 2024. We're at right now 1.7 million 2024. I think in 2025, next fiscal year, that goes up to 2 million vehicles. 2.6 million in 2026, 6 million by 2030, 2035, 8 million, and then kind of hitting more of the plateau at 9.4 million in 2040. About half of those would be from the Model 2, because I think that really the true inflection point is going to be when you have a mass market vehicle that can compete with something like a Honda Accord or a Toyota Camry that has got full self-driving, fully incorporated and completely autonomous. This has been kind of the holy grail that Elon's been trying to get to, not only for his own business and the economics that are so important of unleashing that for Tesla and the cash flows, but also this is, I think, what people want, right? I think that people want a fully autonomous car that not only you can get for $25,000, but can make money for you if you send it out to give other people rides. I mean, it's kind of, a really important inflection point of the auto business.
And you probably have 3 million roadsters per year by 2030.
No, the roadster is in the history museums at this point.
So before we move on to the self-driving pivot, because I know that's a bigger factor in your model, I'm just curious, what are kind of, when you are looking at the risk factors of this model, what are kind of the 3 risks you're most worried about not hitting those numbers that you've put all the way through 2030 and beyond?
Yeah, I mean, the biggest risk of all is going to be the Model 2 just doesn't get the kind of volumes that it needs to. This is something that's a big bet. We know that it's a big bet. Elon likes to take little bets. The Tesla Semi, 50,000 units a year, 100,000 units. That's not as big as something that Elon wants to get to 3 million or even 5 million units a year with the Model 2. So is that going to sell and become one of the best selling, small size sedans in the auto market? There's the expectation that it will. If it doesn't, that's a big risk. And then the other big key risk is, is Tesla actually going to get regulatory approval for fully autonomous vehicles nationwide or internationally? This is why Elon is so interested in politics right now. He's not just doing this because he's bored or he thinks it's fun. There's a reason he gave $100 million to President Trump's campaign. NHTSA, the National Highway Traffic Safety Association, federal government division, it controls safety of trucking fleets and everything that goes on the highway. Kind of a boring division for so many decades, Eric. Now it's like the most exciting thing of all that's going to allow or not allow and have the regulations for full self-driving vehicles that would be on highways nationwide. Stuff like that is super important for Tesla's future.
Yeah, and you saw a big jump in Tesla shares earlier this week when we were recording this, based upon reports that the Trump administration is going to streamline some of those frameworks. So what you're talking about, we have very real things happening around it. So let's make the pivot over to self-driving. I have a Tesla. I took 2.5 hours of drives yesterday. It performed great. I've been very impressed with kind of the step change in functionality around self-driving the past year. They're at, I believe, a $1.2 billion run rate in revenue for that business. But you actually, I don't want to put words in your mouth, but I believe last time I looked at your model, you had self-driving as a bigger contributor to the value of Tesla than actually their automotive business. So is that still true? And could you walk through what you put in your model to arrive at that?
And by the way, you nailed it. Right around $1 billion to 1.2 for the subscription revenue tied to the full self-driving. Like you said, $99 a month. When you calculate that out, there's about 6.7 million Teslas on the roads right now globally. About 7 million Teslas. That's kind of awesome, right? When you think about it, 7 billion people, 7 million Teslas, 1 per 1,000. I mean, that's kind of amazing that they've already accomplished that. Mm-hmm. But about 10% of them, right, have got the full self-driving subscription, right? 672,000 have actually gotten or beta tested the full self-driving. I think that increases pretty significantly. We're still in beta testing mode. We're still in early adopters. I think the mass market is going to get more comfortable with full self-driving in the next couple of years. But there's 2 pieces to this, right? The first is just the subscription that you get, right? Tesla's got to put a lot of money into the neural networks. It's buying the NVIDIA H100 chips. It's got some pretty hefty electrical consumption for the computing required for these things. But at the end of the day, you get a car that drives itself, and you've got somebody that's paying you another $100 a month for the service. So that's the first piece, is just the subscription revenue from the full self-driving software. The even bigger piece, though, the even bigger than the subscription revenue, is going to be the Tesla network, the robo-taxi fleet, the Uber comparison of whether you can replace a human driver in a taxi or in an Uber with a Tesla vehicle that picks you up and brings you exactly where you want to go. And if you can get on an app with Tesla and book a ride and it picks you up using somebody else's car that Tesla doesn't even own the fleet for, Tesla's going to be getting a cut of every single one of those rides. And I think that, quite honestly, Eric, that is going to be a very significant driver of this business going forward. It's probably the reason that Elon is so interested in getting the regulations to work in his favor for autonomous driving.
Yeah. So let's walk through the inputs. To what valuations you have. We could combine self-driving and their robo-taxi network. But what valuation do you have this at, and what kind of inputs did you have in your model to arrive at that valuation?
Yep. So first of all, I don't think this is going to happen any sooner than 2028. Here we are coming up on fiscal 2025. I'm saying at least 3 years to figure this out. This isn't happening next week or next month or next year. You see a fleet of autonomous Teslas just driving around and picking everybody up. It's still going to take time. But with the assumptions that I have, I think by 2028, there's going to be 21 million Teslas in total on the roads. And I think a quarter of them are going to have full self-driving capabilities, right? So let's call that 5.2 million full self-driving subscriptions. And of those 5.2 million that even have the full self-driving activated, I think 2% of them are going to be part of the full self-driving Tesla network that is autonomously picking up people, right? So only 70,000 vehicles out of 5.2 million and 20 million total Teslas out there. Pretty conservative assumption. But then you can kind of, start modeling out, well, what is that worth? If these 70,000 cars are out there driving around, let's say they're putting on average 50,000 miles per vehicle every year. Let's say that it costs $1 per mile for the rider, about half of what you'd be paying for an Uber right now, because there's no manual labor, labor component. Nobody's actually driving. A human being is not driving it. And let's say that Tesla takes 20% cut, a take rate that goes to Tesla of every one of the rides, kind of on par with what Uber is right now. I mean, you add all of those up, that's a $700 million a year income stream to Tesla in the first year in 2028. And that's modest, right? Yeah. 700 million is nothing compared to $100 billion that Tesla's making right now per year on the vehicle business. But I see that growing quite significantly up to $355 billion per year from the robo-taxi network by 2040. And then kind of there's a lot of assumptions in between there, but just to show you how big of a business this is, Eric. And then also that's throwing off a lot of cash flow too, because in addition, there's some upfront costs, right? You got to get the vehicles out there. You got to have the neural networks. You got to have the NVIDIA chips in there, the computing, the electricity and stuff. But after you get it a critical mass, this is a real cash compounder for the business, which is a huge part of the valuation of the stock of what it could be worth.
Yeah. What kind of margins you have that at if, you're looking at it and saying, 355, is it 200 billion profit on that? Or where's that number fall for you?
So I've got them all discounted back to the future, right? And so we can get in. I should have this right in front of me to show you to answer your question, but to show you the price per share of what I think this is worth. I think that we said earlier, I think the car business is worth $140 per share. Mm-hmm. I think the assumptions I put into the full self-driving software, not the robotaxi, but just the software itself, are worth $98 a share. So another $100 a share on top of that. And then I think that the robotaxi network, when you discount all of the cash flows, all the revenues, take out all the expenses, what's the cash flow worth today? I think with the assumptions that I have, I think that's worth $456 per share if they execute on it. So put all those together, combine all those together. I think that Tesla is worth $700 a share if it succeeds with the robotaxi autonomous network out there. And compared to what the shares are trading today, where are we today?
337. I just looked it up.
So a good double from where they are today. But again, it's got to be beyond just being a car company.
And so when you accounting for risk, when you're building a model like this, is that just how you're weighting, your cost of capital? How do you account for risk when you're building out a model like this?
Yeah, the cost of capital that I used for Tesla, bear with me one second as I kind of pull that one up for you. 9.72%. And again, Tesla is becoming a less risky company for people to lend money to because it's got $30 billion of cash on its balance sheet right now. Mm-hmm. Combination of equity and debt, blended average cost of capital of 9.7%.
So one of the key things with this podcast, I want to, anyone can be Kramer and say, buy this, buy that. But hey, it's where you're pulling your actual money. That's why we wanted to do a portfolio. It's showing conviction at any given moment. So, I would ask, do you currently recommend, if you'd feel comfortable saying this, to Tesla, to 7investor members? And is this a stock you own? I'm just curious where your current conviction is on the stock.
Yeah, well, before I say the answer to that, I would say there's a disclaimer. There's a big delta between $140 a share and $700 a share, right?
Yep.
That's purposeful. That's purposeful because Tesla has got a lot of pats in front of it. Mm-hmm. If Tesla shuts down all of its AI and says, too hard, I'm giving up, we're not doing the robotaxi network, we're not doing autonomous, then you probably sell the shares. It's probably vastly overvalued if you're just thinking of this as a car company. It's worth $140 a share just by selling some pretty sleek looking vehicles out there. It's just not an attractive business. It's too hard, too low a margin, too competitive. But on the other hand, Elon knows this. He's not just building gigafactories that are putting steel out there and molding them into vehicles. He's actually investing quite heavily in the data center piece of this. And he's preparing all of the vehicles to be these kind of recurring revenue generating, full self-driving software equipped, cars. And then also the robotaxi network is so important. So the risk of that, if you're investing in Tesla today at $335 a share, you assume that he's going to be successful and the stock can probably double again. I personally think Tesla is a buy at $330 a share. It's run up significantly because there is a de-risking of the uncertainty of getting regulations to work in its favor. And certainly Elon knows the importance of that. And that's why he's trying to be as influential as possible with the federal government right now on safety regulations for the highways. And I think that, there's a lot of other things too. There's a lot of other optionality. The Optimus robots, zero contribution to the model right now. Could he work something like that out? Yes. Elon's got a lot of irons in the fire, so to speak, that could incrementally work in his favor. But I think that in general, if you're investing in Tesla, you're doing it for one of two things. One, Elon is very smart and he makes good on his promises. And two, it's going to become an AI company successfully. It's not going to abandon these projects. It's going to stick with them. Elon has shown us time and time again, he's pretty much right most of the time when it comes to making technical decisions. I think that probably continues. And you got the right guy at the helm, and you got the right projects that can add a lot of value to the share price today. Yeah.
Are there any other self-driving stocks you've been looking at? We've talked just a little bit on the show about Tesla itself, but one really important thing about self-driving, we've looked at AI coming out into the physical world, and what areas do you have lots of first-party data for a company to get an advantage? That's a big reason it's taking off in self-driving. But people will ask about, hey, have you guys considered Waymo and investment in Google as part of it? Have you considered Mobileye or other options? So, are there other stocks in the space that you've looked at and are personally interested in?
First of all, I'm glad you mentioned Waymo, Eric, because you and I rode in the beta version of the Waymo. Do you remember we rode in autonomous car?
Yeah. Well, we back in 2014, we got Waymo. We got to try Baidu's. We've ridden in NVIDIA's demo. So it's been quite an adventure for us across the past decade. And it's rewarding to actually see this now playing out in the real world,
Yeah, absolutely. There's other options. Aurora Innovation is now a publicly traded company. It's kind of focusing on this. Like you mentioned several others, that are publicly traded. I think it's very hard. I think that even when Elon, with all the resources that Tesla has, is still, delaying his own schedule for when can he get it down to $25,000 for the car. Even if you can technically get a car that's affordable, you got to convince people to get into the car and to buy the car and start using full self-driving. Then you've got to convince the federal regulators and the state regulators to allow them to be driven on the roads. I think that the first mover probably is in the prime position to benefit from this trend. That's why I'm mostly focusing on Tesla, aware of the fact that there's a lot of other publicly traded options out there.
Yeah, I got you. So I asked you for 3 ideas. We spent a long time on Tesla, but I love going through that model. You did such exhaustive work. Like you said, everyone's got an opinion of Tesla. Very few people have gone down to the level you have, but you did offer up 3 ideas today. So another one that you want to talk about is an upcoming IPO, a potential alternative to NVIDIA, which should get everyone's hearts being a little bit faster. So let's talk about what you're looking at in the potential pre-IPO space in AI right now.
Well, everybody loves NVIDIA. Every time you say NVIDIA, somebody smiles thinking about how much money they made off of this stock over the last decade, right? Eric, you're smiling right now. I know how this feels. I mean,
yeah.
one of the darlings of the stock. And why? Because it's creating a lot of value that is just being used and is almost a must-have. And there's a lot of people that say, oh, our chips are better than NVIDIA's, because if you say that, you can add 3 or 4 more zeros to the valuation you ask a venture capitalist for. But one that really might be doing it is called Cerebras Systems. This is a company that is expected to IPO here in 2025, early 2025. Not publicly traded right now. We're just speculating that this is going to be publicly traded here very soon. They filed all the paperwork and are probably going to do it here within the next couple of months. But this is a company that says, AI is transformative, right? And it wants to create the chips that are as efficient as possible for machine learning inference, right? You got the training, you have to have a car recognize what a stop sign is, you have to teach the car what that is, but then you actually have to have the car respond to that on the inference side of it, the understanding piece of the computing that's related to AI. And Cerebras has built these massive wafer scale engines, is what they call them. I mean, the chips are this big.
Yep.
They're massive. If you see a picture of Cerebras's chips are just massive. And they're going to be competing against NVIDIA's GPUs that have got 50 times more computing cores, 880 times more on-chip memory, and 7,000 times more memory bandwidth. 57 times larger than the commercially available GPUs today. Why is that important? Well, because if you are building a neural network that is going to be using machine learning inference for really, really hard things, you want to have your computing as efficient as possible. The number of trillions of operations that you can do per second, the teraflops per second, compared to the power that you are using, that you are putting into the servers to do these things, you have to have that efficient because these are just so power hungry out there right now. And I think Cerebras, if it can actually go out there and show that, it's claiming that it's an order of magnitude more efficient than GPUs, 10 times more efficient. I think that you're going to start seeing some of the big data centers who are doing AI computing, the infrastructure as a service providers, the Microsofts and the Googles of the world, but then also those that are building their own data centers, like the Meta platforms and what have you. They're going to start winning some really, really big contracts. And so I just think Cerebras, we don't know as much about them as we know about NVIDIA. They're new. There's a lot of questions about this stock and this company, but my goodness, what a great place and a great time to do an IPO. They're right in the middle of the hottest market trend in the entire world right now.
Yeah, I think there's no question demand's going to be very amplified for this. It's funny, I've gotten the question from people before, why cut up these wafers into these tiny chips? You're trying to cram transistors. I'm like, well, there's a company trying to do the alternative, and it's what you're describing. It's a radical departure from kind of how the entire chip industry has been built. One question though, Simon, I guess, where'd you see the opportunity here in the sense we've got NVIDIA on one side, but it feels like a lot of these hyperscalers that control so much of the demand, they've really placed their bets on their own custom chips as an alternative. We've got Trainium from Amazon. We've got TPUs from Google. So where is the market? Because when I looked at Cerebras's filing, their S1, they currently have basically one customer, which is a quasi sovereign company from the Middle East. So where do you see maybe demand coming from in the next year or two? Who would buy these chips?
Yeah, it's super expensive to even do this. Like even the R&D of developing your own chip, just the design, $30 million per chip, right? So a lot of companies don't even have the trained staff or the scientists or the R&D budget to even spend on things like that. And they got Microsoft, in addition to all the great names you just mentioned that are developing, Microsoft is the next one that's going to go out there and has already been working on its own custom AI chip, is going to spend $10 billion on manufacturing, design, and then all of the operating expenses to do something like that. I mean, if you don't have $10 billion sitting around to commit to something of this magnitude like the hyperscalers do, you're going to look for the next best thing that's out there that's available. And when we're talking about orders of magnitude between $10 billion that Microsoft alone is spending, Cerebras last year in fiscal 2023 did $78 million in revenue, total revenue. So there is certainly a delta between the two of those, but could you triple that revenue again? Just like they tripled their revenue in 2023, going to triple again in 2024 and be on lines, $200 million, maybe $1 billion a year, maybe even up to, $3 or $4 billion. Yes. I think there's certainly, 10x potential for a company like this, given that the mass market doesn't have the resources of the hyperscalers, like you just mentioned.
Yeah. And I guess, that's a good point in the sense that one kind of a medium-sized customer could result in a tripling, and all of a sudden you're way have consensus, and there's rabid demand for shares. So if you were an investor out there, we haven't talked about this particular company on the podcast. Yeah, I'll probably do a little bit more as it comes closer to the market. But if you were sizing this, how would you size it in a portfolio? Is this kind of a 1% hedge against this, making some room against a larger company like NVIDIA? Would you actually be a little bit more aggressive in it? How would you fit this in kind of a portfolio strategy, adding to AI stocks?
Currently, I have Cerebras on our watch list of new ideas for 7 Investing. That's kind of obvious because it's not publicly tradable anyway.
Yep.
But these are kind of companies that I think are interesting, but I'm still playing a wait and see approach to it. Generally, you don't want to buy in an IPO. The reason companies IPO when they do is because typically the market is hot. There's a lot of demand that they can showcase. The people that want to invest, and out of the gate, they're able to raise as much money at as high of a valuation as possible. And typically that kind of comes back down to earth over the following 6 months. There's also lockup periods and things associated with that. But generally, I would not recommend buying right at the IPO and having to get into the hottest thing at the time. There's expectations built into stock prices all the time. I still am saying a wait and see, but certainly an interesting company to keep an eye on.
Yeah, and I did notice in their S1, there's a release clause that insiders can get out within 5 days if the stock is up 25%. So again, I think we'll talk about this more on this podcast after it's come to the market, but a good reason to maybe there's going to be a lot of demand for it, but also the devil's in the details a lot of times with these companies coming to market. So let's talk about the last stock here. This is a stock that we've talked about quite a bit on this podcast. I still haven't added it to the portfolio. We've been focusing instead on kind of applying or buying, I should say, Taiwan Semiconductor, kind of the arms merchant. But I would like to get more semiconductor equipment stocks in the portfolio. So you want to talk about ASML, which is obviously the monopoly in EUV, a great competitive position for the company, but they have had some, recent stumbles. So Simon, I would ask, what are you seeing from ASML right now? And, where is this on kind of your order of buy ideas within the AI space?
Yeah, you nailed it. Nailed it when you said monopoly, right? They're providing 100% of the EUV, that's extreme ultraviolet lithography machines, to the big fabs. So if you're going to go out and spend, $40 billion on a fab, you're going to spend a lot of money on this cutting edge equipment to make anything that's smaller than 7 nanometer transistors, right? You have to etch with very, very small wavelengths of light, and it's absolutely necessary to work with ASML, the only ones that can even do this. And so when if you're the Taiwan Semiconductors or the Samsungs of the world, that you really, and even Intel now, that you really want to have a cutting edge fab, you've had to use the EUV to keep up with the cutting edge chips that are highest performance out there. And your customers are demanding them, right? Apple is going to demand the highest performance that it can for the smartphones. The interesting piece of ASML right now is, Eric, you and I have talked for decades about, is Moore's Law dead? Is it possible to even make smaller and smaller transistors economically? And even though we philosophically question that, we have shown that, yes, you can. Actually, you can actually get down to 5 nanometers and 3 nanometers and now sub 2 nanometers in the size of the transistor case that are being etched into these very, very high performance chips out there. And ASML has found another knob that they can turn to make this even more possible with an even more cutting edge machine, even better than EUV that they had before. And they're calling it high numerical aperture, right? So you can actually focus the light at a different angle, a higher numerical aperture. It makes even smaller than 2 nanometer chips, transistors for the chips out there. And of course, the first customer that came out and said, this is amazing, I want to buy as many of these as I possibly can, is Intel. Mm-hmm. And so over the summertime, you saw a lot of those orders that Intel put in 4Q of last year. They started shipping the twin scan, high numerical aperture machines, $350 million a piece.
Yep.
Eric, this has to be shipped in multiple pieces, using their own freight liners because it's so huge. And then the assembly takes like several months to even set up. Just incredibly complex. It's almost undisruptable to do it, at least using the same technology, because it's so complex of how they're actually doing the lithography these days. But Intel goes out and buys a lot of them. ASML stock is shooting through the roof because it's recognizing the revenues and the cash flows from the shipments. And so I actually was critical of ASML this summer. I put out a lot of content saying I think the stock has gotten far ahead of itself, and I think there's going to be more uncertainties that are going to be related to this. And lo and behold, my Nostradamus crystal ball was correct this time, and we saw the complete opposite from what happened in the summer happen here within the most recent quarter. ASML cuts its forecast, cuts its bookings expectations, says there's uncertainty with China, who's got, by the way, some tense trade negotiations with the United States on, are machines even going to be available to ship to China? Or are we going to cut that off and put it on the exempt list? And then, of course, we saw Intel pushing out a couple of its fabs that it wanted to spend a lot of money on in Germany. And so the confluence of all those has been a lot more uncertainty around ASML's future, and the stock has sold off 40% since the summertime. In my opinion, this is still a very, very good opportunity for investors who believe in the company. I think for various reasons. First of all, this is the upgrade cycle, right? EUV came out back in 2010. ASML invested a lot of money into its own internal manufacturing capabilities, spent a lot of money on R&D. The stock actually sold off 50% between 2007 and 2010. It was investing in itself. It wasn't reporting a whole lot of cash flows, a whole lot of earnings. And get this, after introducing the EUV machines in 2010, it then triples in value in the next 2 years. I think that's kind of, history doesn't repeat itself, but it rhymes. Here now that we've got another upgrade cycle, you're already seeing Intel placing orders for high NA. You're seeing Taiwan Semi is introducing its own gate all around. This is a new nanosheet architecture that they're doing the upgrade cycle for right now. They've already purchased a couple of machines. Samsung doesn't want to get left behind. This is an upgrade cycle for the semiconductor manufacturing business as a whole. And I just think that ASML is kind of in that kind of lull before the inflection point hits. And I think that it's a really good time to start buying shares again right now.
Okay. So you would, because we have been holding off largely on valuation because it's a wonderful business. It's just geopolitical reasons, valuation. You would personally be in a position I'm comfortable buying ASML from here.
I think it's one of my best buys in the entire stock market right now. There's a strong conviction in it right now.
Are there any other semiconductor? Because one point I've brought up a lot on this show, you pull up a 10-year chart, you look at the returns between ASML, Tokyo Electron, Lam Research, KLA. They're all fantastic. They're all in a group. And there is always some kind of share. We've got this, wafer equipment value chain. It's shifting a little bit between them. So are there other players in this space that you've been looking at as well?
Yeah, equipment has been kind of a hot one, that we've talked about a lot, whether it's, air test systems, a company like this stuff that's doing kind of on the back end side of the process, or the front end kind of lithography, like ASML is. It's been a hot topic because there's just so much demand, right? It just seemed like not only was the market saying we want more AI chips, but the government was also saying, hey, here's a 30% investment tax credit for anything that is strategically important to America. So go out and spend money on fabs. Texas Instruments, another great example, a company that's invested in itself to go out and buy a whole bunch of equipment. On Semi is another one, that's kind of got this diversified product line, tens of thousands of products that it's selling, mostly to industrial, mostly to automotive, kind of going through the lull of the cycle right now, right? Cars are a little bit lower in sales, and industrial has been a little bit lower than we've seen in the past. But I think that this is another well-established company getting great margins, selling not only the materials, but also a lot of the final products that companies in those industries. It's just kind of there's a lot of analog chip making that America has relied on from China for decades. And the Trump administration is coming in and saying, it's threatening 60% tariffs on a lot of semiconductors coming out of China. Are they going to continue to pay that and just say, okay, prices are 60% higher because of these protectionist tariffs that the new administration is coming? Or are you going to start looking to replace a lot of those volumes with domestic manufacturers? I think it's the latter. I think a lot of US-based chip makers are going to benefit from this.
Yeah, I agree with that. So, all right, Simon, anything else you want to mention, or else let's take a minute for you to talk about 7 Investing and kind of the work that you're doing over there.
Yeah, thanks for the opportunity, Eric. And really great to chat with you again. You've been a guy that I've kept in touch with for more than a decade, and we've taken some fun trips and seen some cool things, on what's cutting edge and innovative out there. 7 Investing kind of tries to embrace that same thing. Go out there and figure out what's going on, which way the wind is blowing, which stocks do you want to invest in, and then we're actually holding our feet to the fire, and we're investing in these recommendations we're making, putting real money into every single one of them, and have a fully transparent scorecard too. So at any given day in real time, you can say, hey, this is a company that worked out really, really well for you. Here's some that, that maybe we need to sell off the scorecard because they're not doing as well. And so with full transparency and innovation, and then also the, just the love of investing and putting new recommendations and best buys out there every month, we look to empower the individual investor to go out there and make better investment decisions when you're picking stocks.
Sounds great, Simon. All right. So there we have it. We talked about a lot here, but we have a price target or a model that you've built looking at Tesla potentially to $700 based upon kind of self-driving progress and their robo-taxi network. For an IPO stock, you had Cerebras as something that you're looking at, put on a watch list as they come to market. And finally, ASML, sell-off has gone far enough. You have on your best buys now. Anything else to add, Simon, or should we call it there?
That's a good one. Let's call it there. It sounds perfect.
All right. Thank you for your time, Simon.
Thanks very much for having me.
People on this show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.